Hello, hello, hello. Welcome back to the Bitcoin News Channel. I'm your host, Rob Wallace. Thank you so much for joining us today. The markets are in disarray, but we are here with a special guest to prove to you that everything is more than fine in Bitcoin, MSTR land, and that the future is bright ahead. Let's dive right into it. All right, so it has been a brutal 6 months. Bitcoin is sitting at $62,000, down 50% from the October top. MSTR right now is at 118, a level we saw over 2 years ago in March 2024. STRC, the preferred Saylor pitched as a digital savings account, has severely broken its $100 peg and has traded to the low 90s this week. The shorts are circling. The put volume is 3 times the calls, and Peter Schiff is shouting from the rooftops that the whole thing is a Ponzi. Well, 2 weeks ago, Strategy sold Bitcoin for the first time in a long time, and they just bought back 50 times as much. So is Saylor in trouble, or is this the most mispriced setup in the entire market? My guest today says that it is the latter, and he has the numbers to back it up. All right, let's introduce the man himself. We got Dan Hilery on the microphone today. How you doing, sir?
Hey, Rob. It's great to be here. Super psyched to talk MSTR, talk Bitcoin, and get back to, no nonsense analysis here.
No nonsense analysis. We need it because the sharks are circling, dude. It has been a rough 2 weeks for Strategy on the timeline. Saylor's getting attacked from all angles. You've been a bit of a hiatus as of late, and you are coming back to give us what we need to show us the real numbers, why everything in Strategy land is A-okay, and why Bitcoin has a much brighter future ahead. So since you've taken a step back from the markets and daily discussing it all, what do you see right now as we talk live Wednesday, June 10th in the morning? What do you see for Bitcoin and MSTR in front of you?
Yeah, and I think this conversation obviously starts with Bitcoin, and Bitcoin sitting historically at a very depressed price relative to long-term trends, whether you look at historical 200-day moving averages or a power law trend of adoption relative to the hash rate growth over time. It's sitting at prices that are very favorable, and I think there's a lot of even long-term convicted Bitcoiners sitting on the sidelines looking for a better entry, which is a dangerous task because someone in a podcast said it well yesterday that a lot of people are trying to rectify their non-sale of Bitcoin at higher prices, whether that be 100K, 125K, or even 80K, looking to sell and buy back lower down here. And just, based on probabilities, that's a mistake. And it's kind of it now becomes a question of are you humble enough to know that we are in the bottom quantile of a Bitcoin price based on adoption over time? And it's very silly to be trading around these levels, in my opinion. That's why I've been playing a lot of golf. With regards to MSTR, I think maybe we should get into kind of the long-term growth of the business and how this all started in 2020 and then how it evolved in 2022 and then where we're sitting now. Because, management at Strategy has reaffirmed Bitcoin per share as their key metric. They'll always be net long Bitcoin. So anyone talking about how MSTR is in a different position than they were 6 months ago, I think is in a bad way, is quite wrong because the balance sheet is very, very strong. It's robust. It can handle drawdowns. And I'd argue they're 100 times in a better position than they were in 2022, considering how the debt is made up on their balance sheet, how the amplification has been built, and their annual liabilities relative to their Bitcoin stack. So that's kind of the general overview, and then we can work through all those different parts of the puzzle, I think.
Yeah, so let's hop over to Bitcoin first, right? So we are down 50% from the all-time highs of 126,000 back in October. And one thing that we have to be aware of is that this peak up here that we just had to 83 really mirrors the run up to around 47K that we saw roughly around the same time, spring of 2022, before the next leg down. What happened to both of these time periods? It was where were we at? All right, so it's the 200, right? It's the 200, yes, right here. It hit up against the 200, and then went straight down. So do you think that we see another leg down here, or is this really the bottom call here? You've said that below 70K is great value for Bitcoin, and that it really echoes anything lower than this in the 50s would be roughly around the 15K level, is a good analogy that we saw back in the depths of 2022. So what do you see for Bitcoin right here as we hang on the 62,000 level?
Yeah, I'm really not a price action trader, so I can't say anything to assuage too many people's fears. But I believe the market structure is a lot different, especially with Fed policy, monetary policy. And most of the sell-off we've seen is just a working through of supply that was distributed above 100K. I think looking back into 25, one of the biggest signals to the entire market was how many long-term holders are selling into the buying pressure. That was a result of retail speculation and a new cohort of ETF investors and Treasury investors. So a lot of coins were sold into that. Plus, we didn't get a blow off top. And that's the thing that's really interesting is people love to benchmark price based on an all-time high. But if you look back at 22 and 21, specifically 21, we got these spikes in price that didn't last very long. Whereas the all-time high, as we like to call it in 25, was simply a distribution over a long period of time. The realized vol got down to like 30% when we hit that all-time high in October of 25. That's not something you've seen in prior cycles. Prior cycles, the realized vol would get to 100 plus when we had these blow-off peaks of euphoria and mania. Search trends were up, retail was involved, and we didn't see any of that. So I think benchmarking to long-term trends as opposed to total drawdown from a peak is the only way to look at the asset class. And right now we're at historic lows. The realized price of Bitcoin is around 55K. I think that's absolutely possible and a likely floor over the next few months. But again, the distribution over the past 2 years, plus the distribution now of weak hands into long-term holders now buying, is going to take time to play out. So I do believe the market forces, if you look at them objectively, have shifted to a more bullish regime. But again, working through the supply is the main factor. And another point I like to bring up is, through 24, 25, we've seen MicroStrategy, now Strategy, as a net buyer of Bitcoin. But those buys relative to the distributions of long-term holders have been very small. So people conceptually, they focus on what they can see. They understand what they can see. And what they've seen and heard are these weekly purchases by Strategy. Whenever a long-term holder sells, that isn't broadcasted on X or YouTube or anywhere else. And so for those reasons, I think people have this mental disparity where they don't understand why the price isn't going up. But again, there's just been massive distribution. But for the first time over the past few months, in really 2 years, long-term holders have been accumulating Bitcoin at paces that we haven't seen. The Bitcoin market is a lot bigger than Strategy being a holder of only 4% of the Bitcoin supply. And that's one of the benefits of Bitcoin. We could talk about this later. Bitcoin has the ultimate collateral that can be sold at a moment's notice. This is why the Bitcoin on the balance sheet proves to be sufficient collateral for these preferred equity obligations. But that goes with the idea that Strategy doesn't control the Bitcoin price in the short term, or even really the long term at this point in time. So it's going to take accumulation by entities other than Strategy to bring the price back up to levels that people are excited about.
Yeah, 100K was such a mental level that caused so many whales to distribute their Bitcoin. They were able to cash out, some of them with tens of millions, hundreds of millions of dollars after holding Bitcoin for a decade plus. Anecdotally, were you able to talk to any of these whales? Did you get a sense of that outside of just seeing the numbers on a screen in terms of the circles that you run in, that the whales were distributing so hard in 2025?
I'm more keyed in with the institutional folks. So I heard anecdotally through them that there were a lot of, sell orders at the OTC desks by large long-term holders. Other than that, I think people generally don't want to disclose their trading activity as the market could run against them in a short period of time. So I think a lot of this was quiet selling, as a sophisticated participant would naturally do.
And the run we saw from 23, 24, where Bitcoin was the best performing asset, it left us with a lot to be desired in 2025 when we did have the sustained time over 100K with the distribution from these whales. And we also had the Treasury company explosion. So we are about a year past the peak that we saw, the Treasury Co's explosion. You were in the middle of that as well. Give us your hindsight 2020 retrospective on the top of euphoria in the Treasury company space that was just 1 year ago.
I remember thinking in 2023 and early 2024 that the altcoins of the cycle would be companies putting Bitcoin on the balance sheet, and that played out to be true. Because it's really what altcoins have been in historical cycles. There have been these nonsensical narratives about their utility, but ultimately they've been investors looking for beta on Bitcoin, and that's simply what these Treasury were acting as in 2025. And if you look at the net Bitcoins purchased by these entities, it's very, very, very small relative to strategy. And as I just said, strategy's net buys were very, very small relative to distributions to long-term holders. There wasn't a lot of Bitcoin purchase. And a lot of the speculative capital was flooded into these stocks. And by nature, let's say you have a MetaPlanet, for example, trading at 8 times book value. That it takes time for that money to be translated into Bitcoin purchases. If all of the capital that flows into a Bitcoin Treasury equity is converted into Bitcoin itself, that all that monetary energy, then the company would be trading at 1 times book value, because you have to sell all that equity to capture the monetary premium and then pump it into Bitcoin. And what we saw with these Treasury Co's is their premiums expanded, but they couldn't sell equity fast enough and pump it into Bitcoin fast enough to really translate that monetary velocity. And instead of all of these dollars being transferred into Bitcoin, the dollars were then pulled out of these equities as they started to collapse. So I think that was the blow off top we saw specifically in the equities market. And the equities market on top of Bitcoin is effectively a derivatives market. So the derivatives market, the public equities market, on top of Bitcoin absorbed much of the buying pressure that in historical cycles would have flowed directly into spot Bitcoin in the form of both spot purchases and perps, right? Perp hedging by the order books and the market makers. And I think that was really the story and the cycle top that occurred in late 24, early 25.
Let's talk about MetaPlanet, right? Because this time last year, they were sort of like the darling in the market. It seemed as if Saylor saw them as the next coming company on the come up, and that they would be a competitor for MicroStrategy in the long term. But since then, it's been pretty much straight down. And I actually heard you say on a video that you think that MetaPlanet sort of crapped the bed. So what happened to MetaPlanet? And do you think that a company like that can recover and go to new all-time highs?
I think MetaPlanet is a fantastic company, to put it out there. Simon and Dylan are, probably the most responsible management team in the entire space, aside from strategy themselves, by a mile, in my opinion. Look, I think what a lot of Bitcoiners don't understand is that equity valuations tend to deviate from intrinsic or fair value for a company in a meaningful way. And that's happened throughout market cycles during all of history. And the fundamental flaw with the Bitcoin Treasury model as it existed in 24 and 25 was this idea that you could infinitely sell equity and accrete Bitcoin per share. But the math behind doing that is that of diminishing returns. As your market cap grows, the nominal amount of equity you have to sell to yield 7 or 5 or 8% Bitcoin yield on a Bitcoin per share basis increases exponentially. So as an example, if you have a $1 billion company and it's trading at 2 times MNAV, that's a multiple to book value being the Bitcoin on the balance sheet. If you sell 20% of that float of your outstanding shares, that's $200 million of equity sales. At 2 times MNAV, you capture, I don't know the exact numbers, but it's roughly 5% Bitcoin yield for shareholders. If the market cap then grows to 2 billion or 3 billion or 4 billion, that number becomes, for 4 billion, that number becomes $800 million of equity sales to capture the same 5% Bitcoin per share yield. And this is unsustainable in the long run, especially when these MNAVs we're pricing in the future expectation of Bitcoin per share. And that's what an MNAV is. And I feel very strongly, and this was what protected me and a lot of my close investor friends from buying at these elevated MNAVs was, again, like a PDE, right? A PDE is a future expectation of earnings, and earnings can be cyclical. They can grow. You have PEG ratios, which is an adjusted price to earnings ratio based on future expectations of growth in a traditional equity. But for a Bitcoin treasury company, it's a future expectation of Bitcoin yield. And if you only generate Bitcoin yield from equity issuance, then that Bitcoin yield over time will diminish. So you can't place these historic multiples as a multiple of book value on a diminishing Bitcoin per share yield in a very effective manner. And I think the rapid repricing of that multiple is what we saw over the past year or so. And I think in the long run, these companies, their balance sheets are so robust, so liquid, so strong, they'll all be absolutely fine. But I know a lot of people get very emotional about these companies. And they say, MetaPlanet will never retake its all-time high, blah, 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 blah. How do we get MetaPlanet back to 8x MNAV? How do we get Strategy back to 4x MNAV? And look, I think that's the wrong question. I think that the question you have to ask yourself is, why were investors paying such a premium for these equities at that time? And it's like in poker, right? If you lose a bunch of money, the worst thing you can do is try to make that money back by betting bigger or hoping you can get back or betting based on a bigger stack you wish you had. And so if you look at the valuations of these companies now, they're very strong. The balance sheets are very healthy, the majority of them. And you can have fantastic returns into the future, 30, 40 CAGR, even without reclaiming an all-time high in the next 3 to 4 years. And I don't think a lot of them will reclaim their all-time high in 3 to 4 years, but that's not to say their performance won't be very, very strong in the near-term future. So I think that's kind of the equity valuations can get. Look at Oracle. It took them 25 years to reclaim their all-time high. However, they were growing earnings for 20 years after the dot-com bust. And I think that's the analogy you have to look at.
Absolutely. So now let's go over to the King Kahuna MicroStrategy. Of course, Saylor's line was never sell your Bitcoin since 2021. That was the motto. And they did sell a little in 2022 in the bear market to tax loss harvest. But this was the first time in 4 years that they did so. 2 weeks ago, selling 32 Bitcoin. This is 0.004% of the stack, but it obviously sent shivers down the market. So let's take a look at this new stance of going from never sell your Bitcoin to never be a net seller of Bitcoin. What's your take on that?
Yeah, I think it's a two-part answer to your question. First, in 2022, there were barely any eyes on this company. It was a single-digit billion-dollar company, and there wasn't really anyone following the stock. So I think a lot of the noise you see online is simply that there's a lot more attention around strategy, and people don't understand how their Bitcoin purchasing and selling execution has evolved. So now that they have these preferred equities and their main product is Bitcoin-backed credit, they're appealing to a new client base, and that being the rating agencies. And one of the gripes of the rating agencies is they gave Strategy a B- rating, and the majority of their credit products aren't rated. The reason being is they're giving no credit for the Bitcoin as collateral on their balance sheet. It's simply the equity collateral on their balance sheet. And so you have to prove to these agencies that the Bitcoin is liquid, it can be sold, and it can be used to pay dividend obligations. That way, hopefully some point in the future, I think this will take a very long time, the Bitcoin as collateral is given credit against the different products. And ultimately, to get S&P inclusion, this was a very important step. And I think Strategy should have and will continue to sell Bitcoin to demonstrate its viability as a asset that has real tangible value as a collateral base against their liabilities. But the 32 obviously was an experiment to see how the market would react to a Bitcoin sale. I think they'll continue to rip the Band-Aid off and sell Bitcoin into the market. One, capturing the tax loss is massively advantageous, demonstrating, well, the other part of the equation that people aren't thinking about is Strategy's MNAV right now is currently 1.21. When we were collapsing in November of 2025, that MNAV traded at a discount relative to the Bitcoin on the balance sheet. And the MNAV is enterprise value MNAV. So you subtract out the liquidation preference of the prefs and you subtract out the debt on the balance sheet. That's the only way to calculate it, in my opinion. And the fact that it's trading at a premium means the market is respecting the collateral on the balance sheet. And selling Bitcoin shows the market that Strategy doesn't need to dilute at depressed MNAVs in order to pay the dividend obligations, which kind of fends off the shorts. Because if a big player could lean on the stock, short it, sell it, and force the MNAV below par, and Strategy was unwilling to sell the Bitcoin, then not only could Strategy not buy back the stock, but they'd also have to sell more stock at non-accretive prices to pay the dividend obligations, which would further feed the short sellers. So I think this move has actually fended off the shorts, and the equity value of MSTR is stabilized. So that's kind of the blessing in disguise of the Bitcoin sale, or the willingness to sell Bitcoin, I think.
And your long-term vision for MSTR is to essentially become a central bank of Bitcoin. And you think part of this transition to this new era is for them to be more active traders, right? To be selling and buying and provide liquidity for the market and whatnot. So in terms of selling behavior moving forward, do you think it'll be these cheeky little sells, or will they sometimes do a big tranche of, say, sell 1,000 Bitcoin to boost up their cash reserves so that the market knows that they have enough to cover dividends for a year?
You've been studying. Yeah. I totally agree. I think that's how they're going to execute it. I mean, ideally, if there's trading volume in the MSTR equity and it trades at a premium to book value, there's really no need to sell Bitcoin other than to tax loss harvest. But I think they'll continue to do it to demonstrate to rating agencies and participants that they can. But again, I really don't think they'll be selling that much Bitcoin over a long period of time. It just doesn't make a lot of sense if you want to be a net long Bitcoin holder and purchaser, in the market. And in terms of, in response to your second part of the question, central bank of Bitcoin, well, they've taken on a leveraged position in Bitcoin, right, via the convertible notes and now the preferred debt. And when you take on leverage, you have to manage that leverage, and they're actively managing that leverage. They're executing ATM sales of STRC when it reaches 100, and that amplifies the company or leverages the company positively against Bitcoin. So as Bitcoin price increases or they sell common equity, that de-leverages or de-amplifies the company itself. So this is something they're actively trading when it comes to the leverage ratio of the corporation. And that's something they're actively managing, both in the best interest of the credit investors. If they over-amplify, they under-collateralize the preferred equities. And this is a very, very important idea. And I think it's something that Strive and SATA will have to wrestle with. There are all these fancy terms, Bitcoin rating, years to cover dividend, years of dividend coverage, et cetera. But if you want a robust, and by robust, I mean sellable STRC-like product, a fixed preferred equity, a fixed value preferred equity, it needs to be over collateralized by the Bitcoin. It needs to have more backing than the outstanding liquidation preference. And so if the amplification gets too high, the credit of the preferred equities it goes down, right? It's less credit worthy. So as Bitcoin price moves up and down, I believe they'll amplify and de-lever their balance sheet in order to serve those credit investors to the best of their ability, and then also to provide the sufficient amount of amplification for the common holder. Now, as Bitcoin goes up, and if they believe Bitcoin to be overheated for a period of time, or there's been a large run, I expect their amplification to be less than they're currently running, simply because they have to be able to withstand a Bitcoin drawdown. For example, if Bitcoin were trading at 125K and Strategy at that time, if they had 50% amplification, right now they have 42, and Bitcoin had fallen by 50%, then you get to a point where you have 100% amplification. 100% amplification essentially means all of the Bitcoin collateral on the balance sheet covers the liquidation preference, or effectively the obligations of the preferred equities. In that scenario, there's no shareholder equity for the common. You can't do that. The volatility will be way too extreme and the valuations will be too skewed for MSTR. The company won't go bankrupt, but again, they'll create too much volatility in the common equity. So this is what they have to manage. If there's a risk of another 50% Bitcoin drawdown, you don't want to be at 50% amplification, in my opinion. And that's based on Bitcoin's future expectations for volatility as well.
And when it comes to the cash reserve, it seemed as if the market liked it when they had over, what is it, 2 years of reserves to cover the dividends. And they just blew through a lot of that in order to relinquish some debt. So, in your mind, what is the sweet spot for a cash reserve and how important is it for how the market views MSTR?
Yeah, the cash reserve is very, very important, I think, for preferred investors who are looking for kind of robustness and stability in the balance sheet. But ultimately, it's a drag on the common if you believe Bitcoin will outperform that value, cash or USD over time. So I think it's in their best interest to keep it as small as required by the market, and that's something they'll be targeting and experimenting with over time. It also provides them the optionality to buy back the converts at a discount, which is something they should continue to do, as it's immediately accretive on a Bitcoin per share basis, and it increases the credit quality of the preferreds since the converts sit senior to the preferreds, and it de-risks the refinancing risk of the converts, and it de-risks essentially the bankruptcy risk of the company. Without any fixed debt, it's very, very difficult for these companies to go belly up. And that's why Strive boasts their preferred only balance sheet.
So let's head on over to these preferreds. We've got STRC. Let's bring it up on the big screen here. What are we trading at right now? We're at $95.65, below $100, which is the par. I mean, I don't study preferred charts. Do preferred charts look like this? What is going on here from your view of analysis?
Sure. So STRC is Strategy's variable rate dividend preferred. And the idea was they use these novel structures like ATM on a preferred, which is their ability to issue equity freely into the market at any point in time. This is very novel because an ATM has never been put on a preferred equity in history. And this is what allows them to cap the price at 100. They sell more supply into the market whenever STRC hits that $100 price point. So that's a very novel feature. Then the other problem they had to solve for to increase stability of the equity is whenever it trades down like it is now, they have to be able to adjust the dividend rate based on the trailing price or the volume weighted average price of STRC to get it back to par. So over the past 10 days this month, the volume weighted average price is well below $99 on STRC. And based on their mandate, if for this entire month of June, STRC trades below $99 on a volume weighted price basis, they're going to have to increase the dividend rate to try to boost it back to par. So this is less than ideal where Stretch is trading, as it's supposed to be engineered to be very low volatility. It's a new instrument. This is just part of the growing process that I expect in July when we move to semi-monthly dividends. That's another up and coming change. Semi-monthly dividends, the interest rate on STRC will be taken to 12%. And over time, as people gain more confidence in these products, the dividend rate may be decreased and the cost of capital for MSTR holders will be decreased as well. But this is just kind of the natural ebb and flow of these products.
So yeah, this is the big innovation of the last year, digital credit, as they are calling it. But they've gotten a lot of pushback on the marketing, right? Fong Li went out and said that it's like a money market fund, that people should be putting their savings into it. What do you say to the people who push back against that classification of this digital credit? And how would you describe it? And who is it for primarily?
I think a high yield savings account is applicable, but I think a high yield stable return bond fund or some form of secured lending is the most applicable comparison. So any sort of private credit fund or secured lending fund is kind of the total addressable market. Ultimately, it's not a T-bill fund. It's not a money market fund. It's not denominated. It's not backed by the good faith of the U.S. government. But it is backed by the strength of Strategy's balance sheet. So I think the TAM, or total addressable market, for STRC is, the entire bond market, at least the entire corporate bond market, and potentially the sovereign debt market. But until then, it's going to trade with volatility, and I think people have to understand that. But anyone scared of Stretch's trade-off has to understand that unlike the other preferreds, where there isn't any sort of adjustment mechanism, the dividend rate will be taken up, and that will push the price closer to par. And that's the entire design of the instrument. So if you have a monthly or monthly or semi-monthly or multi-monthly view on your capital, on how long you want to hold your capital, I still believe this is a very, very strong instrument. And the cash reserve only buffers it. So right now, the years of dividend coverage for all of the outstanding preferred equities is 30 years. So your money good on those dividend payments for 30 years. And that's not to mention that STRC sits senior to some of the other preferreds. So the years of coverage are actually higher for STRC. And I think the market's underestimating that. Also, the way that ATM works, once Stretch hits 100, strategy issues new supply. The market has to work through that supply. New buyers will step in at lower and lower prices. It's a dynamic market, so the volatility will never be zero. The volatility will always be greater than 1. I expect the volatility to compress again next month into that 98 to 100 band. But it's a long-term savings account. It's not a money market fund is how I look at it.
And as we saw over the last couple of months, there's a high volume of trading right before the ex-dividend date, right? And so what kind of people are arbitraging this? What is that play there in the market?
Well, the way the dividend is paid out, the ex-dividend date is the last date on which you can buy the STRC to be eligible for that monthly dividend payout. So you can buy on the ex-dividend date. With T+1 settlement, you're then a record holder. You're recorded as a holder on the record date, and you're eligible for the monthly payout. There's a lot of big players that hop into the market, and they try to arbitrage this. So over the past few months, the drop in STRC, the price of the equity on the ex-dividend date, has been less than the dividend payout. So you've been able to buy on the ex-dividend date, hold overnight, and then later that month, and then sell on the record date. And you've been able to capture, a 30-cent yield there by only holding overnight. So that's how these arbitrageurs play the game. Another trade that people have been executing is when these people sell on the record date, then people step in and buy at 99 or 98, and then ride up STRC as it accrues value and new buyers throughout the entirety of the month. And so I think those are the natural elements in the market that have been pushing it closer and closer to par and stabilizing its price. The amazing thing about STRC is it incentivizes liquidity providers in the form of hedge funds and market participants to step in at prices below 99 or 98. And this creates natural trading volume in the market. And it creates the stability of the price peg around 98 to 100 without strategy having to enforce it. And this trading volume allows large participants to enter and exit. And that volume's everything. That volume really, really matters if this will be adopted as a large, important, yielding dividend equity.
Well, when it comes to volume, we've seen the little brother, SATA, SATA, running at over 15% of STRC's volume as of late. So, of course, SATA is going to daily dividends within just next week, right? That's when it all starts. So explain the difference between semi-monthly dividends and daily and who it's so attractive to.
Absolutely. So the daily dividends was a great innovation by Strive. And the way it works is it's the same as the X and record dates on STRC. So if you purchase on today, Wednesday, June 10th, you're recorded on Thursday, June 11th, and then you're paid on the 12th. And you can hold SATA and get this income stream so long as you want to hold and get those dividends. SATA is a different beast, as right now it's 60% over collateralized by Bitcoin on the balance sheet. Obviously, these products are collateralized by the cash reserves as well. So you take on more risk when buying SATA relative to STRC, also because the trading volume is different. And for me, the collateralization ratio of SATA is too low for comfort. I wouldn't be comfortable buying SATA here, but the market is clearly a long-term holder and buyer, net buyer of SATA at the moment. So SATA will continue to grow and take market share, but I think Stretch will always be the king. And with semi-monthly versus daily, For institutions, for pension funds, for endowments, for large hedge funds, I don't think there's a big difference with regards to how frequently they receive dividends. But that being said, there are unique pair trades that could be made. So for example, now that Stretch is being paid semi-monthly. So you could buy Stretch on the ex-dividend date after it's traded off to 98, 97, or in this case, 95. You could hold it to recovery, whenever that be. And then once it recovers to 100, you've captured from 95, you've captured a 6% increase in equity value. You could sell it and you could rotate into SATA. And then SATA would pay you until you wanted to execute that trade again on STRC. So again, there's going to be pair trades. There's going to be short-term money that preferred SATA to STRC because they only want to hold for a few days, right? But as STRC matures, the dividends will not be daily, but the accrual of the equity value should be close to daily. Again, if Stretch trades up into the ex-dividend date, trades off on the record date, and then trades back up into the next ex-dividend date, you should be able to hold Stretch and accrue value daily in a mature market. So I think it's going to be interesting to see how people trade that, and if the stability returns to STRC.
So now let's get into what has really ruffled the feathers of a lot of Bitcoiners. It's that, so there's these preferred shares, right? But now there's DeFi tokens being built on top of it. And you worked on one briefly that's no longer functioning, right? A buck token. But there's other ones like Apex, right, that are promising crazy yields, like 40%, something insane out there, right? So how do these DeFi tokens play into the math of all this? And do you think there's a concern there with yields that are getting, frankly, in my opinion, out of control?
Absolutely. So I did start working on one with Travis Vanderzanden, who was the founder of Bird Scooters, and we built Buck. And it was about 7 or 8 months in, we decided that DeFi wasn't the proper venue, and there was too much risk associated with DeFi to create mass international adoption for STRC. So we returned all money to holders. Not a single Buck token holder lost $1. So we're very proud of that. But these other DeFi protocols that have grown to between $600 and $800 million of value are they're essentially wrapping STRC and putting it on chain, on Ethereum rails, on Solana rails, and they're able to be purchased by anyone that can hold stable coins. And that's a pretty big unlock in theory for markets around the world for people who don't have access to brokerage accounts. The problem being is, you have to solve a lot of problems like how do I manage the volatility of STRC, right? Some of these protocols have an extra cash buffer to try to buffer the volatility so their coin doesn't depeg. We're seeing a lot of depegs in the market right now with Apex and with Saturn. And so I think it's going to be an ongoing question of how they manage the wrapper on top of STRC. I think most of the total addressable market for STRC is in the public markets. So I think the focus should and continue to be there. But all stable coins are a potential market for an STRC-backed stablecoin. That being said, there's risks you take on when buying a third-party issued product backed by STRC. There's smart contract risk, right? All of these things are built on smart contracts that trade on Ethereum. And so if those are hacked, then you can lose token value. If the reserves aren't true, then you could lose, money in the token that way. Like they don't own all the STRC they own. These guys are good actors, in my opinion. But again, there's a lot of risk involved. I think they create a lot of leverage. So one of the big unlocks in the DeFi world is there's decentralized lending protocols where there's pools of capital that are formed in protocols like Aave and Morpho, where you can then deposit Apex or Saturn, you can borrow USDC and go and buy more Apex and Saturn and deposit it and do it again. And so this is called leverage looping. Exactly. So you can loop this thing up. You can loop your STRC up to 5x, 10x, but you obviously have a liquidation price. So if STRC trades down like it is now, there's going to be a lot of forced liquidations by those pool providers. That's going to create forced selling on the side of Apex and Saturn, which then creates forced selling in the STRC market. So I think a lot of that reflexivity will continue to support the volatility of STRC in a non-desirable way. The point being, the final point I'll make on that is that the volume with as a $600 million outstanding market cap of DeFi tokens relative to $10 billion outstanding of STRC, they can't really put a meaningful dent with a forced liquidation into the price of STRC on any given day. But if that market grows, I think it's something to watch for sure, as people are degenerates and they love to loop. And one last point on the looping, the reason it's profitable, if you loop STRC 5 times on Morpho or Aave, you get the arbitrage between the 13% yield offered by these products and the 5% cost to borrow, or 5 or 6% cost to borrow on these lending protocols. So you can get your APY with essentially a liquidation price up to 20, 30%. And that's what these people are starving for. And then to your point, how are these people getting these 40, 30% on these DeFi tokens? Well, in the DeFi world, there's a real competition to give out rewards. So Apex and Saturn really aren't profitable because they have to distribute all their protocol revenue into extra incentives and earnings in these markets. So it's a very competitive market. There's all kinds of incentives just to play ball. Plus, people are levering the base yield plus the incentives on these protocols. So it's a very shady business. And I think there will be problems moving forward.
It seems sketchy as hell to me, dude. That's the biggest red flag that I'm seeing. And you can't stop anybody from building on top of this stuff, right? Anybody can go out and buy the STRC and then put it into these DeFi protocols. But the one thing is that Saylor has been retweeting them. And then he's gotten into some hot water just in the last day he's been called out for retweeting. He said, I'm not endorsing these things. I'm just telling people about them. And I think with a platform as large as his, of course, 5 million followers on Twitter, it's hard to say the difference between endorsement and just notifying people that they exist, especially just because of how risky they are. STRC is enough of a new product that I think you shouldn't be focusing or putting any attention of yours or your audiences on these things that are building on top of it like that. So I don't know if you have any opinion on Saylor retweets when it comes to these things.
I think his heart's in the right place. I mean, stablecoins are a $340 billion market growing 40% year over year. Like, stablecoins have found insane amounts of product market fit for users around the world. And I think STRC is effectively a stablecoin backed by Bitcoin monetary policy instead of USD or Fed monetary policy. I think that's a huge, huge idea. So I believe his heart's in the right place, and the right product done properly could address the stablecoin yield problem, especially because these things won't be treated as payment stablecoins. These will be essentially tokenized securities. So where I think the market's headed, and this is not consensus by any means, I think tokenized equity providers like Kraken and other issuers will safely wrap STRC and provide on-chain exposure that, while people may go out and leverage them, you can leverage these things in your brokerage account too. Like, people are getting leverage everywhere. As long as the providers are reputable and the smart contracts are bulletproof, I do think there's a world in which these take some of the stablecoin market share, and I'm very excited about that future. So again, I don't think he's wrong for promoting some of these things, but obviously, I mean, he's got more lawyers than I do, so he makes the final call.
Yeah, and what you bring up is the fact that these things have yield, and we're just seeing this battle right now with the Genius Act and the Clarity Act, that the banks really don't want stablecoins to be able to offer any yield. So just had a conversation with Matt Cole 2 weeks ago, and he was saying that he's preparing for a battle in Congress versus the big banks because he thinks they're going to come down hard on these preferred equities for the yield that they offer. What do you see in that regard? Do you think that this is a threat to the business model of, say, JP Morgan?
Yeah, I think it is. I mean, most financial institutions offer preferred equities, funny enough. So I think it's going to be difficult for them to come down on them in that fashion. And I think they'll fight hard to call them a Ponzi. And I've thought about that a lot too. Like, Stretch could really, really threaten the dominance of high yield savings accounts and different offerings, high yield preferred funds by the banks. But we're seeing them wrapped and included in a lot of these preferred ETFs, BlackRock's preferred ETFs. So, my thesis is that STRC will become systemically important to all sorts of different, yield ETFs. and it's going to be difficult for this product to be outlawed. I think one thing to look for is the change in return of capital treatment. I think if STRC becomes really, really, really successful, there may be legislation that's lobbied to change that treatment because it is so unique to strategy and their position in any sort of Bitcoin treasury company. I could see the banks lobbying hard to get the return of capital treatment taken away so that STRC is taxed at the same rate that a traditional bank preferred is taxed at. And then they're just competing on yield, not preferable tax treatment.
That makes sense. And when it comes to Wall Street, it's full of sharks, right? And when sharks smell blood in the water, they attack. And it's funny because I think Michael Saylor, he's sort of, he's adored by many in the Bitcoin community, but he's also looked down upon by many in Wall Street and these financial circles. And so if they can find a way to attack him, they will, as we saw with Jim Chanos when he shorted when MSTR's MNAV was above 2, and he wrote that down, and then he exited the trade. What are some disaster scenarios? Like, how can these guys attack? How can Wall Street attack MSTR? And are there any levels when it comes to the share price of MSTR or the price of STRC to look out for that it gets to a danger zone?
Yeah, the daily dividend, the semi-monthly dividend on STRC is massively important as it bars shorts from really laying on it aggressively, as they have to pay that dividend cost for being shorted. So I think it has the perfect structure to force buyers back to that $100 price point, so long as strategy is willing to raise that dividend. So I think it's a pretty robust product in that way. With MSTR, the problem, the fear, the risk has always been depressed MNAVs below 1 that are irrecoverable. And if you can get the MNAV below 1 and then they're forced to dilute below 1 to pay dividend obligations, that would create a non-positive spiral in a falling or flat Bitcoin environment. What they've been able to do by selling Bitcoin is demonstrate that they're willing to defend this MNAV for their common equity investors in order to execute accretive transactions, whether that be selling common equity above 1.22 times MNAV or simply using that to build their cash reserve. I don't think there's a lot of, and in terms of technical levels, I don't really comment on those.
Yeah. Well, I will say one thing as somebody who got caught up in the 2024 MSTR mania. I bought some MSTR at like 350, something like that, right? And so I'm down, and it does feel as if the new darling is STRC, and that they are willing to dilute common shareholders in order to make sure that these dividends get paid. What do you say to the people who aren't interested in STRC, hold MSTR, and feel like they're the bag holders right now?
Yeah, what I would say to that is you have two options as a shareholder if you're looking for amplified or leveraged Bitcoin. You can go out into your brokerage account. I use Interactive Brokers. I'm not sponsored by them. You could lever your Bitcoin on margin, and you can get your amplified Bitcoin exposure that way. You take on liquidation risk. You can get margin called. They can change the margin requirements. They can change the margin rates all against you, and you can be pretty much wiped out of your leverage position in the case of volatility. With MSTR, they've created a balance sheet with the preferreds such that the cost of capital is much higher. Right? I pay 4.75% margin on Interactive Brokers for my leveraged IBIT and FBTC position. With MSTR, I'm paying roughly a 9 or 10% blended cost of capital to hold a leveraged Bitcoin position. But they have mechanisms that I can't use in my own brokerage account. If that MNAV expands, they can accrete Bitcoin per share that way. For example, if the MNAV is at 1.5 and they issue equity to pay the dividend obligations, then it's effectively like taking their dividend funding rate down, right? If you can sell equity at a premium to the Bitcoin to pay fixed obligations, then the fixed obligations are essentially cheaper relative to the Bitcoin because of the premium in the equity. So they can take their cost of capital down that way by boosting their MNAV. But you don't have liquidation risk. They're about 10% debt, so Bitcoin would have to fall 90% from here for the converts to take the outstanding Bitcoin, essentially. And I really, really like the long-term optionality of MSTR because of these kind of perpetual duration securities. So while they're focusing on STRC, if you believe Bitcoin's going to go up over the next 5-10 years, they're going to need to issue a lot of STRC to maintain a sufficient amplification for your risk tolerance. You don't want to hold MSTR if they have zero amplification. You don't. You want to leverage Bitcoin equity, and that's the whole value prop. I think they know they're going to have to sell billions, tens of billions of dollars of this STRC stuff. So it's in their best interest to spend the next couple years or 18 months really, really focusing on the appetite and investor demand for that product, because they already have 270. What is it? How much trading volume do they have in MSTR? It's they have $2.7 billion a day in MSTR trading volume. So that equity is mature. They need to mature STRC as equity as well.
Yeah. And one thing Saylor himself has come out and said recently is that the AI capital rotation has been one of the reasons for the slide in Bitcoin and MSTR in general. Are you paying attention to the wider markets right now when it comes to the AI trade? And what about the big IPO, SpaceX? Do you think that that marks a top?
I think it's difficult to say. I mean, earnings are there across the entire NASDAQ index. Earnings are growing at 15% year over year. So it's difficult to call this a bubble, especially with, NASDAQ really performing that plus PDE expansion, but it's a lot different than the dot-com boom. In terms of capital rotation, yeah, I agree. Bitcoin's not behaving like levered NASDAQ, which it has throughout most of its history. I think that's very, very nerve-wracking for a lot of investors. They're really abandoning ship and looking for beta anywhere they can find. I think investors ultimately just look for beta, especially through tech super cycles. And Bitcoin's not performing like that. It's performing actually closer to that of gold. Gold's performance, I think it's difficult to know, what market force is causing price to behave in this or that manner. I think a lot of people look for explanations. And the thing I've always thought with Bitcoin is it remains completely unchanged, right? Bitcoin has remained largely unchanged since 2017 and more or less since its inception, is that price drives narrative. If Bitcoin were at 150K today, we would be talking about it like it's the greatest monetary asset known to man. It is the deflationary debasement hedge that we've been looking for in an AI abundance era, yada, yada, yada. It's actually very quantum resistant. It can be made more quantum resistant. We have a net buyer now with STRC. All these are strong narratives. Now that the price is down, we talk about all these counter narratives. It's capital's being sucked out of it. It's no longer this top performing beta asset. It's been flat for 5 years, et cetera, et cetera. So, I mean, I think you look for price and then people make up their own stories.
And one thing that you use to help guide you is the power law. And so we're at the bottom range of the power law quantiles now. Give us your take on the price action when it comes to the power law, and has it surprised you?
Yeah, we've definitely been underperforming. So we're sitting right around the power law floor, and we broke below it for a while in 2022. And nothing's an absolute. I mean, the power law has always been kind of my framework, a decaying exponential for Bitcoin price growth and adoption. The power law is based on sort of a network adoption based on total addresses and hash rate growth. Price is then a derivative of those two power laws. And I think over a long period of time, it will show that it was a good mental framework for understanding where Bitcoin could go. Using that chart, I always believed we could get down below 70K sometime in 2026. And that helped kind of mitigate, or it helped temper my expectations. And I think, it's very difficult to know where we'll be heading in the future, but it's been the best reference point, especially the Bitcoin power law floor, which has been largely stable since 2015, for understanding how price could grow in a bull case of adoption. And my last point on that is, for the power law trend to continue, there needs to be sustained corporate, institutional, and just general broader adoption of Bitcoin. So anyone saying that, this or that breaks the power law to the upside, I really don't believe that will happen. I think the power law is the most bullish price projection forward based on sustained continued adoption and inflows into Bitcoin. So I am confident and excited to see where that leads, but I do believe the adoption floor, right where we are now, is kind of the base fair value of Bitcoin itself.
Yeah, and in order to see Bitcoin continue to grow along the power law, we're going to need to see increased adoption, more flows into it. And I mean, power law calls for $1 million Bitcoin sometime in the mid 2030s, right? And $10 million Bitcoin in the mid 2040s. At this point, I'm happy with that, right? Maybe a couple of years ago, that was like, oh, that's too slow. Bitcoin's going to be $1 million by 2029 or whatever. Well, no, I think we'd be more than happy to see Bitcoin at $1 million in the early 2030s. Is that where your head's at? And what do you think takes Bitcoin from the 100K range to the $1 million range? Like, what do you see in terms of real world adoption and corporate adoption?
I think if Bitcoin switches to kind of, the value prop of Bitcoin is its risk off properties, in that the network doesn't change. The network's durable, stable. It's backed by energy. And it's the only digital asset that has those properties. So now we have a net buyer of Bitcoin that's looking to eat into the bond market, which is 100x larger than the total M2 money supply. So I think what strategy is doing is totally the right move. Targeting the bond market, bringing that bid into a fixed asset, into a finite supply asset, is massively important. So I think Stretch could be a very, very strong catalyst over the next 10 years. And that's what a lot of people, especially in this kind of AI era, right? With equities, we've seen them trade 10x in a month. They go up because of these bottlenecks in supply. We have these bottlenecks all over the place, and there's a lot of momentum trading going on in the market. I think what people forget about Bitcoin is its strongest attribute is durability and duration. So in 10 years, Stretch will still exist. MSTR has built their balance sheet to continue to exist into perpetuity. So MSTR will still be around, Stretch will still be trading, and Bitcoin will continue to be an asset in 10 years. And in 10 years' time, if Stretch will have been paying the dividend for the next 10 years, which I expect they will be, it will be a very, very creditworthy instrument to institutions, to pensions. Bitcoin will be, 10 times more creditworthy, and the amount of capital people will be willing to put into these assets will be, a multiple of what they are today. So time is your friend in this asset class, and I think that's difficult and painful in the short term for a lot of people seeing gains happening elsewhere.
100%. All right. So now you personally, you of course have been studying MSTR and Bitcoin when did you start? 2022 or before that?
2023.
2023. And
MSTR 2023. Yeah.
And so what's up with Dan? What are your plans? What do you got moving forward? Where should we put our attention when we're looking at you and your work?
I'm probably going to start posting a few more videos, getting some more content out the door. But my future plans are not yet disclosed, but I'll keep everyone updated on X for sure.
Cool. Nice, man. Well, I think that was an awesome conversation. You definitely helped dispel some of the FUD that's going around out there. I think the MSTR community definitely needs a voice like yours at a time like this. And you've definitely got the answers, I think, at least, for how we are going to weather the storm and come out on the other end a much better place. So, Dan, if people want to follow you and your work, where should they go?
Feel free to follow my X account, Hillery, HILLERY _Dan. And then also or is it underscore? Let me see. Yep. And my YouTube is linked there as well for more kind of, longer form videos.
Yeah, check out Dan's YouTube. Some great stuff, and I think he'll be creating more soon. All right, everybody, thank you so much for tuning in. Again, we do this live every Wednesday, 11 a.m. Eastern, new guest each week. We got a long-form podcast, comes out on YouTube on Mondays, clips throughout the week, a long-form deep dive on Fridays. So much good content coming out. If you're watching live on YouTube, definitely hit that subscribe button. If you're watching on X, retweet this piece, and let's get the word out there that things are not so bad. Bitcoin will more than survive, and Saylor's got this ship under control. Dan, thank you so much for your time today. Until next time.
Thanks, Rob. This was a great